If you have watched some of my videos, especially my monthly portfolio update videos, you know I am a dividend value investor. Yes, I always include the word value in it, as I am not just hunting high dividend stocks, but stocks that have good fundamentals, bought at reasonable prices, plus having good dividend payouts. This, in turn, lets my dividend machine run even through the harshest economic troubles. Now it's funny that I'd be making a video about is dividend investing still worth it during a time when markets are in shambles. If you aren't aware, the PSCI is at 3-year lows, it's at pandemic levels below 6,000, and here I am protecting dividend investing while my portfolio took a big hit from this market downturn. But for me, this is exactly the best time to say how worth it this strategy is. I've been investing for 6 years now. I started when the PSCI was at the 8,000 level, and after just a year of investing, I experienced a pandemic market crash, tumbling the index along with my portfolio down more than negative 40%. Just imagine a newbie investor watching their money cut by more than half. Most would curse investing, not touch their portfolios for years, and may not even invest again at all. But for me, I continued with my strategy during these tough times, consistently investing, picking the companies I'd analyze as strong and would give me consistent dividends. Back then, when the index was below 6,000, my portfolio was down negative 35%. Then fast forward to the present day, where the index is so close to that level again, my portfolio is up 34% and has a compounded average of 9.7% a year. Not much, but this is with the market still in the range of 5,500 to 6,000, which is down negative 26.6%. Now, if you're new to investing, compounded returns are one of the best ways to assess your total performance, especially if you're adding every month to your portfolio, as it takes into account the amount and the duration of how long your money has been invested. This is easy to track. You just need to have a history of the money you put in every month, as well as your portfolio's present value at those times. For shortcut, my compounded return here is computed using XIRR, Extended Internal Rate of Return, which for me is the most accurate way to see how your money is growing. This formula accounts for all your actual cash flows, money you put in or take out, plus the exact dates they were invested, and how your portfolio grows during that time. This is why if I compare my returns to simply Wall Street, it's different, as it uses only internal rate of return, which is always going to give you a higher amount. So what I'm showing you guys is well tracked and accounted for. But anyway, the US index in its history has a compounded or annualized return of 8 to 10%. So how is it that my portfolio has a compounded return of 9.7% for the past years while our index is down more than 25%? Why is my portfolio's return different now compared to back then, when at the same index level in 2020, my portfolio was negative 30%? Did I doctor my returns? No, everything I show you is the real deal. In fact, after searching far and wide, my portfolio might be one of the most documented individual investor portfolios in the Philippines that's publicly available. I've been showing my monthly updates as far back as 2021, even during the times when my portfolio was deep in the red. And I show the platform itself, not just Google Sheets, but the actual broker platform. I only started doing these monthly updates when my portfolio's value was 800,000, but my data collection started in July 2019 when I first began investing. I receive a lot of comments and criticism, but I stayed true to my strategy. So how is my portfolio different now? Well, I credit 3 things: dividends, compounding, and patience. You see, just because the market is down doesn't mean your portfolio has to move the same way. Unless you're investing solely in the index, during the lowest points of the market, I invested big. 90% of my salary went straight into stocks, month after month. I bought blue chip companies at record lows. One of my most successful buys was TMCI, which gives me a staggering 20% a year in dividends alone. If I had panicked back then, I wouldn't have bought this gem. Right now, I've already ROI'd my entire DMC investment just from dividends alone. I did this across most of the stocks in my portfolio, even the ones that are still in deep red today. I invested consistently. The dividends I received were reinvested fully back into my portfolio, and those dividends have compounded. When you count in dividends, even my losing holdings eventually turn into gains, and some losses are cut dramatically. More than 60% of my total gains come from dividends. My portfolio's current dividend yield is 6.1%, with a yield on cost of 6.9%. And my latest 12-month dividend income is now 19K a month, and that yield just keeps getting higher because with the market down right now, I'm continuously buying strong companies, including some that weren't considered high-yielding before, but are now great dividend stocks because their prices have dropped so much boosting their dividend yield. Now, before we continue, a quick side note: if you're looking for a broker to invest in the Philippine stock market, then look no further than Dragonfly. Their platform is the most advanced in the country. They offer tons of features like a dividend screener, news, and their signature portfolio, where you can even copy the stocks of different investors, such as me. How great is that? And right now, they've also launched PERA, which is similar to the Roth IRA in the US. This is the first tax-free retirement account here. Now you can easily handle your PERA account in your mobile phone. No papers or going to the bank. So if you want all of this, sign up to Dragonfly using my link, and you can get up to 1,500 depending on your initial funding. Thank you, now back to the video. So this constant buying at cheaper prices plus reinvesting all my dividends into the most undervalued dividend stock in my portfolio has pushed my portfolio upward, even while the market is at its lowest. The divergence between my portfolio's return and the index's return keeps widening because of this. And even if, for example, I stop adding money to my portfolio today and just let my dividends grow it, after 30 years, it would still grow to around 37 million pesos, giving me 2.3 million pesos a year in dividend income. And that's only counting dividend growth, not even capital gains. So just imagine, yes, some would say my returns are very small, but for me, it's a big accomplishment because I had one of the worst timings of all. I started when the market was at one of its highest points. I'm just imagining how much my portfolio would grow if the market finally recovers. Who knows? But looking back at my old videos, when I was showing negative portfolio returns, my journey is clearly taking a good direction. And I really credit that to my continuous education about the stock market. So for me, the biggest takeaway for those who want to start investing: educate yourself first, learn the basics, prepare yourself mentally. A lot of investors just start because they watch or saw some random post about stocks, thinking they already know enough. Then when their stock drops even just 10%, they run to a chat group asking, should I sell? Should I still hold this? And honestly, this is the most common thing you'll see in stock market chat groups. Why do they panic so fast? Because they don't know what they're doing. They don't know why they bought the company in the first place. They're not mentally prepared to handle the ups and downs. For me, stock market investing is 90% psychology. So how do you protect yourself from panic? Educate yourself first. Second, take out the noise. As I said, investing is mostly psychology. If you drown yourself in market noise, constantly listening to chat groups for answers about your holdings, chances are you will panic. Your emotions will take over and you will likely fail. You know the hardest part of my journey? My monthly update videos. I open myself up to the noise of others. So how did I maintain my sanity? Easy. When a hater pops up in the comments, hide comment forever. And I never opened a public chat group for this exact reason. I want to focus on my strategy, not what others are saying. I always go back to Warren's words: focus on your inner scorecard. This one mindset alone can save your portfolio. Third, have a quick checklist before you press the buy button. And I emphasize quick, just like in everyday life. Before I leave the house, I run through a mental checklist: keys, glasses, wallet, watch. Same with investing. Before you buy, run a quick checklist. How are their earnings? Is the equity growing? Are they managing debt well? Are they paying dividends consistently? Are you buying at a reasonable price, not because of hype? The list could go on, but this alone could save your portfolio. If the stock drops, then you can confidently say, wait, this company's strong, I can buy more. Instead of going into instant panic, a quick checklist is a must before buying stocks. If you still like the company after it passes your quick checklist, then learn even more about it. Remember, these are actual companies, not random stock symbols. You're becoming a shareholder, a part owner, so of course, you should do your due diligence. Just like how you research before buying a laptop or phone, do the same here. Run your quick checklist first. So these are my takeaways. Continue to educate yourself, not just about the market, but study books about general finance. It may even help more. Next, take out the noise. And lastly, have a checklist. With that, this ends this video for today. I hope you've learned something. If it did, be sure to hit the like button before you leave. Thank you and see you in the next video.